Are you or someone you know looking to buy or sell a home? When you use a HomeGain Realtor to buy or sell a home, you can get $150. Visit HomeGain.com and click on the Promo 150 banner at the top of the page to get started. Compare HomeGain Realtors and choose your favorite. Complete your home purchase or sale transaction with a HomeGain Realtor, and HomeGain will pay you $150. Get started today by going to HomeGain.com.
Welcome back, Washington, D.C. Metro, to Real Estate 360 Live with Ryan Sloper. I'm joined today by my guest, Louis Cammarosano, the general manager of HomeGain. Quick reminder, Real Estate 360 is designed to build the D.C. Metro's market by giving you good free advice. If you ever have any questions, concerns, or real estate needs, the best number to reach out to us is 877-245-2030. That's 877-245-2030. Or you can reach us via the web at realestate360live.com. That's realestate360live.com. If you have any questions, there's an Ask a Question button on the right-hand side. Feel free to enter in any question. I'll get back to you by the close of business today. Louis, before we went to break, we were going to jump into kind of silver and gold prices and what's been the trend lately. It seems like over the whole month of January, they've actually been rallying. It's been a pretty significant increase, especially in silver. Last week, silver was up, I believe, 3.8%, and up close to the futures. The March silver futures are at $32.34 an ounce, which is a pretty substantial jump for a 1 month. Wouldn't you say so?
Well, silver's gone up a lot since December, and also silver is trading. I think it's around. It normally trades at a historically at 16 times less than gold. Right now it's closer to 50. So silver is just playing some catch up to gold.
Yep.
Didn't correct as much as silver had, and that's always the case with gold and silver. Silver corrects enormously and then also explodes enormously to the upside. That's partially because it's a more thinly traded commodity than gold is.
Yeah.
Although I've heard in recent months that the dollar amount, at least of investable amounts of gold and silver, are relatively equal, which is really good news for silver.
Yes, absolutely. And it's interesting because I was reading somewhere, I believe this is Market Watch, it was said that a lot of this advance maybe came as Europe was reportedly setting to consider prohibitions on any trade of precious metals with Iran, amongst a host of other proposed sanctions. The EU's foreign ministers were due to discuss the sanctions at a gathering in Brussels later Monday, which would be today. So, I mean, I guess there's a lot of other things going on, but also I'm still reading that China and India is buying up these precious metals by the boatloads. And I would think that that's going to continue. Wouldn't you agree?
Well, I would agree. And also, if you look back to the historic high of silver, which was $50 back in 1980, when gold hit its historic high at $800, China and India really were not participants in that market, and now they are.
Yeah.
So that really gives a impetus for additional buying that didn't exist when silver hit its high. And I repeat, silver hit its high 32 years ago almost, of $50, and it's only $32 right now.
Right. I mean, and to be honest, I mean, this is just my opinion, but I mean...
excuse me, that's without, with inflation and adjustments.
Right.
That $50 number, that's the nominal high.
Yeah, and I mean, that's why I think, I mean, really, in my opinion, is that at $32, $31, I mean, that's a bargain, especially with knowing historically where it was at. I mean, and we're definitely in a spot where the inflation could shoot through the roof in the next year or two. In which case, if you do hold silver and gold, I mean, you'd be in a good position.
Well, the thing about silver, it's also not just a monetary metal, but it is also an industrial metal. And throughout the 80s and 90s and early 2000s, the main industrial use was photography. Now that's gone away. However, it's been substituted with solar technology. There's a lot of silver used in solar technology, and there's also a lot of silver used in the expanding electronics market. So that's picked up the slack. And then, of course, there's additional investment interest. So silver does have some attributes that gold doesn't have. Governments don't own silver the way they own gold, and so therefore they can't really buy and sell it as a manipulative tactic.
Right.
But as I mentioned, silver is a much less widely held asset, and therefore it's subject to those wild swings. However, if you look at the trend, forget the inter-day or the inter-month, but over years, silver has done quite well.
Yeah, absolutely.
You have the stomach for 20, 40, and 50% drops and rises.
Yeah. And I mean, if you're planning on holding this long term, I mean, as we see things play out, as long as we continue to print money and not decide to cut into our deficit by any means, which I don't see that happening. Like you said, none of them. I don't think really any of these plans are going to do anything to really bring us back to where we need to be. Gold and silver. I mean, in real estate, I mean, if you're able to couple those things, I mean, you're going to put yourself in probably a pretty good position down the road 5 years from now.
Well, gold and silver have never been worth nothing, and generally homes don't, go down to zero unless there's toxic waste on the land.
They're tangible assets as well, Right. We're going to jump into this week's market movers, where we're going to, let you know what's on deck this week that could affect real estate, mortgage rates. And this segment was brought to you by HomeGain. HomeGain is the place to get you started buying or selling a home, finding a realtor, and getting real estate questions answered. So you can go to homegain.com today to see what I'm talking about. All you have to do is type in your home address, and you'll get an instant free estimate of your home's value online. It's a great way to monitor your home's value, and it's totally free. So make sure you check that out today at homegain.com. So as I discussed earlier, it wasn't a good week last week in the bond and mortgage markets. Interest rates had increased on the increasing optimism that the U.S. economy was improving in the face of Europe's slide, and which kind of reduced the need for safety in U.S. treasuries. The 10-year note, which tends to have a good relationship with actually mortgage notes, the yield increased 15 basis points last week, which in correlation to actual mortgage rates, they were up 8 basis points. Now, to you, the average person out there trying to understand what that really means, what that really meant is that interest rates were up about 0.1% on average. Now, depending upon your credit qualifications and everything, it could be higher, just depending upon what other, hits there might be to the rate for credit score, for loan to value, and whatnot. But start today, they were pretty much unchanged from last week. There are really no economic releases this week until Wednesday. This week is going to be primarily focused on the Fed meeting that starts tomorrow and ends Wednesday with a policy statement. Also, the Treasury will auction its monthly ration, I believe, $99 billion in 2-year, 5-year, and 7-year notes. The Eurozone, of course, is always in play these days, so if there's any significant comments from leaders of the EU, the ECB, and the IMF will get traders' attention. So technically, we just need to watch these bond and mortgage markets after last week's selling. And I would remain pretty bearish on the overall markets, but I don't think at this point that we're going to see rates kind of go up or down too much. I believe we're getting ready to stay in a range, because I believe the 10-year, if it increased to 2.15%, I think it'll hold at those levels, because it's a moving day average, I believe, of something like 120 days at this point. So I don't anticipate there being big swings. But like I said before, if you're in the market, lock in your rate. Don't play with fire at this point. They're at 70-year lows, and I would hate to see somebody lose another eighth or a quarter just because they're waiting for that to retract that by that amount.
And Ryan, to back up that point, let's look at, you mentioned there's safety in treasuries. That's a perceived safety. People buy and sell the 10-year because there's a low interest rate. They're highly liquid. However, I don't think there's anybody who thinks within 10 years the United States is going to buy that bond and get it paid back. Well, if you think that the United States won't be able to pay back that bond in 10 years, by then we have $15 trillion outstanding. We can't pay that back. We just keep rolling it over, and people are willing to buy it and trade it. But if in 10 years we can't pay it back, well, interest rates are going to be a lot higher, and we saw that in Italy and Greece once the investors realized that there's a great potential that the only way that that entity can repay it is either through raising interest rates or printing the money. Now, if you think, forget the short-term changes in interest rates right now, one would have to believe long-term, as you say, interest rates have to be higher. And that argues not to look at the daily swings in the 30-year mortgage, but to think to yourself, will mortgage rates really be 4% 5, 6, 7 years from now?
Absolutely.
And if the answer is no, and if you take out a 30-year mortgage, you're going to stay there, that's what you'll be paying 5 or 6 years from now. You'll still be paying the 4%.
Yeah.
And that argues to go and get that interest rate locked down, because if we do have additional inflation, rents are going to rise, interest rates are going to rise, but you're locked in.
Yeah, absolutely. And I have these conversations daily with people, and I say, okay, let's just take, for instance, you're willing to risk to try to gain another quarter. So instead of 3.875, let's say you want 3.625.
You might get it.
You might get it. But is it really worth gambling and trying to have everything play out and the timing of you trying to close on your home and you having to lock in before you close? And it's really not, because when you look at the long-term cost associated with it, I mean, there's so much room for interest rates to go up. There's not near as much room for them to come down.
Right. So unfortunately, like if with silver, if you think it's going to be higher in 5 or 10 years, you can space out your purchases. You can buy some at 32, maybe it goes back to 28. You can go buy it at 34. The problem with a mortgage is you buy it once.
Yep.
Out the loan once.
Right.
So I understand why people think like it might be able to get another quarter point, but over the long term, you're going to lock in something that is, as you mentioned, historically low. And we don't have a crystal ball, but I can't imagine interest rates being at 3 or 4% 10 years from now.
Well, Lewis, I mean, if somebody would have told you, 10 years ago that you could have a home loan at 4%, what would you say? You think they're crazy? Somebody was probably crazy to offer a 4% mortgage. I mean, you would have thought it was probably unheard of, right? And now it's become almost like where we think that this is what's owed to us by the government is for them to keep rates low.
Well, they keep saying, the government has an interest in keeping rates low because they won't be able to service debt if it's a few points higher.
Absolutely.
But the only thing they can do is they're not going to default. They will inflate their way out by printing more money. And if they do that, even if interest rates don't go higher, you're going to have much more inflation.
Yeah, and
have to raise rates. But then it's kind of a catch-22.
Yeah, and inflation
Either way, you're going to lose the value of the dollar.
Right. Yep. But
if you lock in at 4%, you'll be paying back the loan in inflated dollars. It won't, the amount that it could be the price of the postage that you send it in is the price of your mortgage.
And more than likely, you'll be laughing your way all the way to the bank for all the people that are want to stay renters. You know what I mean? Because what's going to happen is and we're already seeing this in the DC metro area, is that the rates of rentals, the price of what you're paying for rent is increasing dramatically. I mean, literally from one month to the next, we're seeing, it increasing and increasing and increasing. I can only imagine for people that are on year-to-year leases where they might be in 5 years. We're talking about you have the opportunity to lock in at 4% or sub 4%, depending upon your credit qualifications. And let's just say that payment's $1,500. You might have the same similar style house on that block that's renting for $1,450 right now. But where is that going to be 5 years from now? Now, we don't have the crystal ball. We're not going to say that necessarily it's going to go up every single year. But I'm going to pretty much bet that in 5 years from now, instead of $1,450, it might be $1,650, $1,700.
And your mortgage is still $1,500.
Still, exactly.
And even if your home price goes down, you have to remember you're still only paying $1,500 a month. So you can absorb some downside depreciation on your home's value.
Yep.
Especially if you're not selling, as long as your cost of living there stays at $1,500.
Absolutely. And I mean, you at least have the opportunity then, to do the things that you want to do to your home as well. And not, not get caught up in, I have to do all these things to get my value up. Stop worrying about that. The cost of your home ownership is very important. And I think people don't take that, as serious as they should. When we come back, we're going to jump into HomeGain's 2012 National Home Ownership Satisfaction Survey when we come back. Stay right there.